Welcome to the Deep Dive. Today, we're tearing into a truly revolutionary case study in global finance, M-PESA.
This deep dive is about understanding not just a successful product, but how a mobile money service engineered one of the greatest leaps in financial access and economic empowerment ever recorded, really.
Right, specifically for low-income communities in Kenya and, well, across Africa.
Exactly.
So our mission is pretty simple. We're going to pull apart the specific user-centric innovations that allowed M-PESA to bank the unbanked.
And how its business model evolved from just simple transfers into this massive digital ecosystem.
And the social change that resulted, the quantifiable social change.
To really appreciate the scale of that, you have to rewind. Go back to Kenya around, say, 2006.
Okay.
The vast majority of the population was just completely excluded from the formal financial system. Our sources confirm that only about 26% of adults had access to any formal financial services.
So if you didn't live near a bank branch or you didn't have the right paperwork, you were just out.
You were simply out. You couldn't participate.
And that lack of infrastructure created these staggering logistical problems, especially around the basic necessity of sending money.
Oh, absolutely. Think about the life of an urban worker. They need to remit part of their salary back to their family in a rural village. How do they do that?
Right.
Without electronic options, the traditional method, as our research notes, was often deeply insecure and so inefficient. People were forced to, and this is amazing, entrust cash to a bus driver or a courier.
That single fact, entrusting your life savings or that month's crucial support to a stranger on a public bus is it's astounding.
It is.
It highlights the insane level of friction and risk involved in the most basic act of supporting your family.
It was slow, it was expensive, and obviously so prone to loss or theft.
Meanwhile, though, something else was happening. The ground was shifting rapidly beneath that old system.
That's right. While bank branches were scarce, the basic mobile phone was becoming ubiquitous. Mobile penetration was just exploding across the continent.
Creating the perfect, low-cost digital platform for a real financial leapfrog.
And this is where the story takes a really surprising turn. M-PESA didn't start as some big commercial remittance giant.
No, it began in 2005 as a Vodafone corporate social responsibility initiative. It was actually funded by a grant from the UK's DFID.
That's right. The initial concept was almost academic. They wanted to pilot a mobile-based, a microfinance program.
And it was designed for a very specific problem.
A very specific problem. It was designed to make it easier for existing microloan clients in Kenya to repay small loans using their mobile phones. Just a loan servicing tool.
But sometimes, the market tells you what it really needs.
And it sure did here. During that pilot, the team observed something completely counter to their original plan. Users were not primarily using the system to repay loans.
So what were they doing?
They were sending e-money to each other, to remit money to family members or friends far away.
So that was the pivotal moment, the real discovery.
It immediately illuminated this massive, unmet, latent demand for person-to-person money transfers. And Safaricom saw it. They recognized the commercial and social gravity of this insight, and they made a huge strategic shift.
They pivoted the entire focus of M-PESA away from microcredit.
Immediately.
Yeah.
Right, to a simple nationwide peer-to-peer remittance and payment service.
That move to just center the entire business model on what they saw users doing rather than their initial goal, that was the genius stroke.
He really was.
But a pivot like that, especially with money, needs regulatory approval. So how did they convince the Central Bank of Kenya to let this digital upstart proceed?
That's a crucial question. And the sources show that the Central Bank of Kenya deserves immense credit for its pragmatism. They granted a critical letter of no objection for the launch in March 2007.
So they basically said, go ahead, but with conditions.
Exactly. Innovation could proceed, but with a strict condition. All customer funds had to be held securely in a regulated trust account. They allowed the agent networks instead of bank branches, but they made sure consumer protection was there from day one.
And that pragmatic support let them scale incredibly fast.
Unbelievably fast. They initially targeted 350,000 users in year one.
And they ended up with
over 1.2 million. By 2010, so just 3 years after launch, M-PESA had reached half of all Kenyan households. It became the single most widely used financial service in the country.
It just fundamentally disproved that whole notion that the poor weren't a viable market.
Absolutely. M-PESA showed that if you provide a reliable, simple, and trustworthy service that solves a painful everyday problem, even low-end calculations will rapidly adopt high-tech solutions.
Okay, so if the original products was just P2P transfers, how did M-PESA evolve into the massive financial ecosystem it is today?
Right. It wasn't one single change. It was really 4 continuous waves of strategic adaptation, all built on that initial success.
And the first and maybe the most critical cornerstone is the agent network.
Yes. M-PESA understood this essential principle that high-tech must be paired with high-touch.
What does that mean in practice?
Well, the mobile service was simple, but users in a cash economy need a physical place to convert cash into digital currency and then back again.
So they built that physical network themselves.
They established an extensive agent network, local shops, kiosks, market stalls. They all became authorized cash-in and cash-out points, essentially a bank branch on every corner.
Just picture that scale for a moment.
Yeah.
Today, there are around 160,000 plus M-PESA agents in Kenya. That vastly outnumbers all the traditional bank branches combined.
And the key takeaway for you is that this network provided incredible physical convenience and, crucially, a trusted human touch point, someone familiar in the community who could guide you.
Okay, so that's cornerstone 1, the physical trust network. What was 2?
The second was rapidly expanding the utility beyond just P2P transfers. Once users trusted the system for sending money, M-PESA broadened its scope with key partnerships. They introduced PayBill.
For utilities, school fees.
Right, digitizing those large-scale payments. And crucially, they digitized local commerce with Lapa na M-PESA.
Which means pay with M-PESA.
Exactly. And this tool allowed nearly 500,000 businesses and merchants, from high street stores to tiny market stalls, to accept digital payments easily.
Which would have also reduced the security risk for those merchants, right? Not having to carry so much cash.
A huge reduction in risk. And then they pushed the ecosystem globally. They partnered with services like Western Union and PayPal for international remittances directly into an M-PESA wallet.
I saw they even launched a virtual card.
The M-PESA Global Pay Visa card, yeah. A virtual card that lets users shop online internationally. It connects the previously unbanked to the global digital economy.
So that brings us to the third evolution, which tackled formal financial products. They moved beyond just payments to introduce credit and savings.
Yes, and seamlessly integrated them. The flagship product here was M-Shwari, launched in 2012 with the Commercial Bank of Africa.
And M-Shwari offered 2 things, right?
2 things at once. A mobile savings account that actually earned interest, and short-term microloans. The genius was the underwriting.
How did they do it?
It was determined automatically, based purely on a user's M-PESA transaction history. For millions of people, this was their very first time having formal access to a savings account or any kind of institutional credit.
And then came Filiza in 2019, which is, maybe the most influential service globally today.
It's an instant overdraft service. If you're making a payment and your wallet is short, Filiza instantly covers the shortfall so the transaction can go through.
And it's become an absolute behemoth.
The sources note that by 2022, Filiza was dispersing the equivalent of over $10 million in overdrafts per day.
Per day. That scale of instant liquidity is just unparalleled. It enables huge flexibility in household cash flow. That daily volume is stunning. But it does raise a necessary question about responsible finance.
Oh.
What did the sources say about the risk of debt spirals with these massive micro overdrafts?
That's a vital point. And the key to mitigating the risk is really transparency and control. Filiza's interest is charged daily, but the system is designed to incentivize very short-term use.
So the loans are extremely short cycle.
Very short. And the transaction data that powers the whole system also ensures that the credit limits are kept small relative to the user's overall activity. They dynamically adjust the limits to manage exposure and prevent that kind of catastrophic debt.
That makes sense. The data they collect acts as the buffer. So finally, the fourth adaptation. The pivot toward MSMEs, the micro, small, and medium enterprises.
Indeed. Which, form the real backbone of the Kenyan economy. This involves dedicated M-PESA for business tools and, crucially, B2B credit solutions.
Like what?
Specialized products like Filiza Biashara, which is a merchant overdraft service, and Talasi business loans. And again, the credit underwriting is purely data-driven. Your loan limit is dynamically determined by the business's M-PESA transaction volume.
I read that top-tier merchants can access loans up to, 400,000 Kenyan shillings?
Which is about $3,000, yeah. And this is a huge leap because traditional banks often reject these small, informal businesses.
Right, no collateral, no formal record.
Exactly. M-PESA provides the digital sales history they need to assess creditworthiness and inject that much-needed working capital right into the economy.
So what does all this evolution mean for Kenyan society? I mean, the transformation is breathtaking.
It is. The share of adults with formal financial access jumped from 27% in 2006 to over 80% by the mid-2010s.
And that's almost entirely due to mobile money.
It is a direct attribution, but the impact goes deeper than just having an account. It's about economic resilience. There was a landmark study by researchers at MIT and Georgetown.
Yes, I saw this.
They found that M-PESA directly caused an estimated 194,000 households, that's roughly 2% of all households, to move out of extreme poverty.
That is a staggering, quantifiable link between a tech service and massive poverty reduction. So that really validates the pivot they made early on, focusing on those risk-sharing remittances.
Absolutely. The primary mechanism was improved risk sharing and resilience. When crops failed or a health crisis struck, families could instantly get emergency remittances from their social network,
Preventing them from falling further into destitution.
It also had this powerful and often overlooked impact on gender equality.
The studies highlighted huge benefits for women who gained financial autonomy.
Right. Our sources mention that over 200,000 women in Kenya switched into business or retail occupations, partly because mobile money gave them access to capital and, critically, private savings.
Which traditional communal cash systems often curtailed.
And on the macro level, the volume is just staggering. M-PESA processes transactions worth an estimated 35 trillion Kenyan shillings annually. That's over $300 billion.
Mobile money payments now account for a value equivalent to over half of Kenya's entire annual GDP. It truly became the circulatory system of the economy.
It really did.
So that level of integration offers some profound lessons. First, the absolute necessity of being user-centric. You have to pivot based on observed behavior, not just your initial assumptions.
Second, that critical principle they mastered. Building trust means that high tech must be paired with high touch, the role of that sprawling agent network.
And finally, M-PESA proves that profound social impact, empowering millions and driving genuine financial inclusion, is not at odds with commercial success. It's the clearest modern example of doing well by doing good.
M-PESA's journey from a small microloan pilot to a digital financial super app that transformed a nation. It just showcases the immense power of leveraging existing ubiquitous technology to solve urgent real-world problems.
A defining template for inclusive growth. So as we wrap up this deep dive, consider this provocative thought. M-PESA's explosive growth in Kenya depended on a unique set of factors: Safaricom's market dominance and that early, very supportive central bank.
A perfect storm, in a way.
So given those unique conditions, what specific localized adaptations regarding regulatory relationships or competitive strategies would be absolutely essential for a similar platform to achieve that same level of inclusive growth and scale in a highly regulated or fragmented market like, say, South Africa or India?
The lesson here is that even the greatest templates need rigorous localization. One size does not fit all.